Good morning, everyone. Welcome to the show. It's a real pleasure and treat to have Tavi Costa on. He's a member and microstrategist over at Crescat Capital. Most of you know very well who he is. A great voice out there on macro strategies. He's been an important member of Crescat since 2013, I believe. So most of you do know him. If you don't, I mean, he's been published in Wall Street Journal, Bloomberg, Reuters, Yahoo Finance, you name it. And I'm a constant watcher on LinkedIn and X to see just the graphs, the discussion. It's amazing, and he gets lots of traction for it. And what a time to have. I mean, it's a real treat, too, because there's a lot of questions right now with the past election. What's happening with gold? We're taking a bit of a hit. Bitcoin's soaring. We're going to talk about a million things, and we're a real delight to have you here, Tavi. I really thank you for the time. And listen, we're going to go everything from a macro outlook to what's happening, with debt and in the markets, what you see for precious metals, and we'll go from there. Send in your questions. I'll try to keep an eye on them as well while we're talking to Tavi. But this is a real treat, Tavi. Thanks so much for being on here. And what's your take right now? How are things looking?
We're seeing thanks for having me, by the way.
No, of course. Yeah.
I think we're seeing a mix of signals in markets right now since elections. I mean, we have very significant underperformance of the mining companies relative to the S&P 500. We've had gold also underperforming the S&P. We've had even emerging markets doing the same. So all these trades that tend to be very linked have been not doing so well. It's been shown a lot of weakness. And on the other side, we've seen the dollar actually taking more appreciation relative to other fiat currencies. We've seen especially the 10-year yield pushing higher, but also other durations on the interest rates of the U.S. We've had the break evens moving higher too, which is the inflation expectation rate. So as you can see, there's a lot of mixed signals, right? Yeah. How do we get inflation expectation to rise as much as it has been recently, with copper not following? So I think that these mixed signals are not gonna last, and so the real question is which ones are the real moves and which ones are likely to be the fake moves. And I have my views on this, and it's remarkable to see gold actually under, I would say, extremely oversold right now at near 2,600. Right? I mean, this is wonderful for those who still believe in the thesis and are able to buy assets when they get cheaper. And so this is your opportunity to start adding, in my view, and start building a position into these very important asset classes that I think will be beneficial of the next coming decade here.
Well, thanks. I wanted to get that right out in the open first, because that's, of course, what I hear from people is like the wind is out of their sails a bit. Like they're like, oh, what just happened? We didn't expect this to happen. So to have someone come on and kind of walk us through, and we'll get into details about that, what's happened with gold and silver as well. And let's look at it from this global kind of perspective. Do you think it's, and I'll say a false sense of we've got a new administration, all is going to be well, all problems will be fixed somehow, and there's some sort of elation around that without acknowledging, listen, there's significant issues with debt, with the US dollar, with things that don't go away, even with a great plan, just by changing administration?
Yeah, I think that the markets tend to stretch those narratives and change narratives every time we have a significant outcome like we've had recently with the Republican sweep. And the chances of a lot of things potentially changing from a policy standpoint are certainly should be of a lot of relevance. But there are things that are true constraints when it comes to policy making. And I can mention one of them that I think it's extremely important, and that is not only, regardless of which politician is leading or economy, although they may have a lot of impact on some of those macro trends, I believe still inflation is here to stay. We may work on things that can help inflation, but there are other things that are much more ingrained in the system. One of them not only the labor markets, but really, in my view, is the commodities market. We have not changed, the way that the supply of those natural resources remain very cheap, or I should say, very limited and cheap as well, in my view. But and I don't think that has really changed the picture. Now, the biggest thing is, the conversation is going towards, can we cut spending? Can we cut fiscal spending in a large way? And I think that the answer to that, or potentially the way to tackle that question, really is, can we sustainably have rates where they are, especially in the short end? And I don't think that would be the case. And so I've been of the view that we're going to really see a suppression of rates in the short end of the curve, and therefore why we have a steepener trade in our portfolio, that we think that the long end of the curve will move higher, substantially higher than the short end of the curve. And in my view, as inflation stays sticky and as a part of the reflection of inflation expectations continue to move higher, I would say that's the real risk, is that we see a suppression of rates in combination with inflation actually is starting to reemerge. And there are many signs of this. Look at natural gas prices. We've seen food prices starting to rise. Recently, we've had gold prices rising, and now they sold off more recently. But that trend that we've had since the beginning of the year has been one of the strongest trends for gold that we've seen in many years. And so, no, nothing has changed from that perspective. I think that we're in the process of seeing the reemergence of inflation, in my view. And as we see that occurring, this deglobalization is one of the most important things happening, regardless of Trump or any other politician. I think those things are much more of a reflection of the debt problem we have globally that tend to drive more tension. And so, yeah, I don't think, I don't think that the elections will change some things, but not that big picture of the gold market. If the U.S. and other places want to be buying Bitcoin, that's fine. Just know that other central banks are definitely buying gold, and that would change the dynamic of the quality of international reserves of some of those central banks.
Well, that's interesting. So on a global scale, then, even a gold pulling back, this is a further strengthening, one could argue, of, say, that BRICS narrative and that story. And I know that people point out and go, well, they're not doing this part of it. They don't have a currency. They haven't locked in. The fact that they're meeting and they are setting up ways and means of trading outside of our system and setting up, if they can, their sense of an IMF type of situation. The obvious sign is that they want to separate, or at least have options. And that is good news for them. If they see gold pull back a bit, well, they'll pick up some more, I imagine.
Yeah, I don't think that's going to change. I think if we looked at historically since the 1970s or so, I believe it was right at the end of the 70s was when we peaked on the ownership of gold by central banks at about 74% relative to total assets of central banks. And today we're still sub 20%. And so, if you think about the potential for the demand and the rise of demand coming from those large institutions remains unseen. And so I think we're gonna be experiencing the upward purchases of those central banks of those metals. And not only that, but I would say that what changed here with the Trump administration has been really the refocus towards onshoring relative to green revolution efforts, and we got to pay attention to those changes in policies. And I would say that the copper idea, the copper trade, the copper investment thesis for copper itself remains untouched. And I think that there's a big catch up for copper itself. If you think about what the 1970s as an experience of how commodities behaved during that period, copper was one of the metals that actually led the way to the upside alongside with silver. Elon Musk putting out today that we're going to see, solar panels being the majority of what we may see in terms of electricity, or I should say source of energy moving forward. I mean, those are all important aspects. We know that the demand for silver partially comes from solar panels, and that has been increasing quite exponentially actually in the last few years. It used to be single digits, now it's double digits. You can kind of see where these trends are going. So all that is likely to remain in place. But for the mining industry, I don't. All that is extremely exciting, and I think we're going to see very good partnerships come along with other regions of the world. And to me, it's still shocking to see this overvalued market in the U.S. And we're still trading,
Yes.
3, 4, 5 times, depending on the metric you look at, of equity markets and companies in the U.S. versus Latin America, Asia, even Europe. And so I don't think that that's sustainable. Personally, I think we go through phases and decades that that leadership aspect changes over time, and we're not seeing that right now yet. But I do think we're going to see it. I think we're going to see a big transition out of the equity markets in the U.S. and into other places that have been very cheap in my view.
Yeah, there's definitely, there's one benefit, I guess, for the stock market going up is most of the funds seem to be, conglomerated around very few stocks, and they're doing a lot of buybacks, and that helps them in particular. But what do you think here? We see in the news today, and the narrative being, copper being suppressed and down, and some of the producers down as well the last 5 days because of this notion of tariffs. And I'm going to get off the politics thing. I only want to bring it up because, in my view, it doesn't really lead anywhere. I agree with you. Is that I think that this new administration is very clear on critical metals. They were before. They have their list. They like them. And then if people say, well, he won't do any of the green transition, it's like, well, he's got Elon Musk on his side, on his team right now. You don't think that he's going to be pushing everything that he supports and invests in and creates? So what's your take on that kind of overall synthesis of this team that he's put together, so we can kind of quell that narrative, and then we can move on just from that and focus on markets?
Well, extremely market oriented, but also if you understand Musk and you understand Trump, two of the things that they're actually have in common is that they're big spenders. And, are we likely to see cut of spending of things that are superfluous to the fiscal agenda? Sure, I think we're going to see that. But the pro-growth spending is probably going to increase as well. And so it's important to remember here, because I think this is understood by most, is that regardless of these changes in the fiscal side and in terms of tightening up the budget and so forth, there are things that cannot be changed. And those things are entitlement. Those things are interest payments on the debt. And unless we do radical changes, what are those radical changes? Suppressing rates. Well, that can fix the problem. That's a large percentage right now of fiscal spending itself. And so those are going to be more meaningful changes in the fiscal agenda than cutting the support for or the entire education department from the federal level, and all those sorts of things have been said recently. Those things will be very marginal changes in spending. So hence why we're still seeing 10-year yields rising. Pay attention to that too, and that's because what we're seeing actually in the U.S. is a collapse of pro-growth spending. And that's not because we're not spending money. It's because the other stuff that is just non-growth has been becoming a larger percentage of the pie. And as we see that happening more and more, the only way to reverse that trend would be to change entitlements, in which I think it's highly unlikely in the near term. And the second way would be the suppression of rates. In other words, reducing interest payments relative to GDP. And this is where I get to my dollar view, is because, if we're going to see that, which I think it's inevitable, we're probably, if you look at, I think Paul Tudor Jones was referring to this as kind of like a restaurant menu. You look at all these items and see, all right, which one should we cut here? And the first one that comes to mind outside of that will be meaningful is suppression of rates. And the suppression of rates is likely to have a very big impact on the FX market. You think about what's the sense of urgency by the Fed relative to other countries in terms of cutting rates is much larger than Europe, much larger than Japan, much larger than Canada, and in most emerging markets. And the main reason for that is because interest payments to GDP of those economies is substantially smaller. And so, and this is not my view, this is just, factual data. And so I think that that's going to become a big part of the discussion that has been kind of hidden more recently because of elections and the outcome that we've had recently.
So yeah, do you think that this is just kind of a hiccup? Like we saw like $1 billion outflow from gold ETFs. Does that some just profit taking and just kind of people just kind of settling in, possibly just algos just to click in to make a quick trade? Because once again, like you're saying, there's nothing in the greater macro that has changed. I mean, we've got some certainty with issues that are arising. And also my take would be, and tell me if I'm wrong, there's no benefit for any new administration to come in and say, we're not going to pump a bit more, and not have an option to go, we have to decrease rates, pump more money in to get more of a leveraged return on investment side, rather than, like you're saying, some of the social stuff you have to pay for, but other ones like we'll cut back that and they can kind of have a win on both sides.
Yeah, these things, it's very normal to see after a large move in gold prices, should it be shocking to everybody that, we're losing a little bit of the momentum, and these things are probably going to come back here. And so nothing has really changed. I mean, if you recall back in 2022, September 2022, the Wall Street Journal put out an article saying that gold has lost its reserve status. Gold was trading at $1,600. Now we're $1,000 higher today. This is not too long ago. And you think about what has been the cost of mining change since that time, not big. I mean, it hasn't really been as large as the increase of gold prices itself. So the mining companies are doing very well at these prices. If we get back to the 2,200 level and so forth, yeah, that's going to squeeze their margins significantly. But I'm not of that view. I think we're going to be settling around where we are. And if that's the case, I mean, remember, things are pretty oversold. They can always get more oversold, and nobody has the sort of crystal ball to understand where things go to. But look, you have to understand that long-term fundamentals of this idea, and I don't think that has changed. Look, I haven't changed a bit of my view. I haven't changed my strategy whatsoever. In fact, I think that these types of declines are great opportunities for those trying to build a real portfolio of high quality assets in the space. And so I'm very, to me, this is time to be busy, not time to be worried. But we know that investors are not that way, and that's why it creates such incredible opportunities in the long term. While especially this new generation tends to focus so much in short-term money, and short-term money is great, but it's not where the real money is made. And so, in my view, this is a great opportunity to be stepping back and thinking about what should you do if you're of the view that gold would be substantially higher 3 to 5 years from now. And I think there's a lot of things to be doing here. And so hence why I've been so focused in this industry.
Let's maybe talk a bit, and I won't go into too much detail because you guys are a hedge fund, and we encourage people to go to Crescat site, where you do a great job of giving away a lot of education for free. You're here talking to us, but you've got a fund with mandates and with a set strategy. Maybe tell us a little bit about what you guys offer over there to begin with, and then I'm going to kind of pick your brain a little bit. And we won't talk about specific producers, right, unless you feel comfortable, because I don't want to put people on the spot, but maybe just like the all-in sustaining cost, which we touched on, things like that, which look promising moving forward, pipelines of projects, and what your overall take on the producers is, and then we'll kind of flow into your overall take on juniors, if that's okay.
Sure. Look, we've been of the view that this has been a sort of a conservative opinion formulated by a lot of different supporting arguments for why we think metals and mining industry will become again a critical industry, but also that we're going to see the underlying metal prices substantially higher given where we see the global macro imbalances. And not to get into that unless you want me to, but that created this idea of potentially setting up a fund that focus almost entirely in this industry, not almost, I mean, entirely in this industry, which is our precious metals fund. And the initial stages of this fund has been very focused on exploration, given our views about that segment of the industry. And it still is, in my view, where most of the billionaires have made their money in this exploration segment. And so why we partner with a guy like Quinton Henney to help us discern which ones we think are high quality versus less of a quality types of companies and projects out there. And our view is sort of setting up something similar to a hybrid venture capital approach. In other words, deploying capital in multiple companies that we think could be the next unicorns of the mining industry, and seeing those come to fruition, trying to improve our odds by taking an activist approach and changing, especially management focus on different things that we think are more relevant when it comes to drilling, when it comes to creating value from a geology standpoint. So to go back to your question about the producers and all sorts of things, look, we know that when gold prices rise, usually that means inflation is coming, and usually that means that the cost for producing is also likely to rise. But there are times in history when creates a little bit of a lag where the mining industry tends to benefit tremendously. And those are usually inflationary periods, or times when you have this kind of commodity super cycle, when the early 2000s is a great example where we didn't see inflation, but we did see a substantial price increase of commodities and hard assets. And I think it's a combination of the two. Is really the fact that we've had for so long capex of natural resource companies being so suppressed, that is usually the big factor that causes commodity prices to bottom, but also producers to bottom, and hence the other parts of the industry. Usually we tend to see capital flow into the larger miners and then into the smaller miners. And that's just a function of understanding of the industry and the fact that the earlier stages of this part of this industry, what you tend to see is a need for more understanding as well of the technical side of this, which is the geology aspect. And the geology aspect has been basically in a losing momentum when it comes to interest from younger folks, from older folks. We've seen a lot of shifts to technology. We've seen shifts even within the geology space to the copper industry, or especially the oil industry, which has more money, and that has been causing inefficiencies in a lot of these, in the exploration and development side of the mining industry. And so that excites me. I think there's a lot of things that are mispriced. We're seeing companies that put out, I do not want to get into specific names for compliance reasons, but yep, we've seen some incredible companies putting out results that intrinsically improves not only the asset quality itself, but also the potential for finding more and more discoveries. It's important to know that there's very, yes, there might be a few anomalies, but not really. When we tend to see a large intercept of mineralized, either gold, silver, copper, and any other metal itself in some of those drill programs, usually it is accompanied by a large body of a deposit that is hidden underneath, and usually that's where the opportunity lies ahead. A lot of people are they get excited when those news are published, and then the stock sees an appreciation, but then things kind of faded out, and you sort of see people getting onto the next story rather than building a position on something that is really high quality. So that's the opportunity for us right now, given the fact that the industry is facing a supply dilemma, where most of the major companies today, the Newmonts and Barricks of the world are seeing production falling, are seeing the depletion of their own reserves, are seeing the deterioration of their quality of their reserves as well. And so it's going to push at some point growth. And just like in the 90s with technology and other industries that tend to see uprise is that you tend to see growth being pushed by board members, by investors. Once you start seeing that change, that's what drives the merger and acquisition environment that I would think would also put some of those exploration names that have high quality assets to be in that target for being acquisitive targets to most of these major companies. And so this is where my focus is, but also I'm seeing opportunities on the private side of of companies that are producing today, that have cash flow and are just being ignored. And so if you're able to secure financing to acquire those assets and actually have a cash flowing business where you have ways to sort of direct that cash flow and take an approach of long-term vision that most of the major companies aren't taking today, I think there's quite a lot to be done. It's actually shocking to see that most of the billionaires of this industry, with maybe an exception of one or two, are just sitting back and relaxing. They're not really busy trying to do things here. And I find that interesting. I think we're in the process of seeing some new entrepreneurs, some new guys stepping into this industry and potentially, making successful decisions that can be, ways of or vehicles that will be incredibly successful, in my view, for the next coming cycle for gold and other metals too.
Do you think that there's any change in the model today, whereas we're coming into VRIC and PDAC, which tends to be a very big M&A kind of discussion behind the scenes? I'm sure that'll be the case this year. Do you think some of the majors are thinking of any exploration themselves? If they go, oh, you know what, maybe we should delve into this a bit more. We haven't traditionally in the last decades. We've just kind of bought projects. Or do you think that they'll just stick with, no, M&A looks attractive, we should just buy near-term projects or ones that are highly profitable and build them out? What's your take? And no, once again, no specific companies, just the general.
Yeah, I think there's a chance that we may see some of that exploration budget. I mean, for a fact, we're at one of the lowest levels we've seen in history. When you look at even CapEx itself and you break down sustaining CapEx versus development CapEx, we're seeing the development CapEx basically completely faded away in the next few years, and especially in even the more hyped metals like lithium to copper and others like gold. And so in other words, we're seeing a bunch of sustaining CapEx. So when you think about it, well, okay, CapEx is really suppressed historically, but even within CapEx, if you look at the percentage of CapEx is going towards development of new mines, it's very low. Development also means exploration, which is also something that has been historically low too. So it's becoming more and more challenging to find new discoveries. And if spending is not following that, then you would suspect that we're not going to see much of new discoveries. So supply is likely to be constrained. And it's important to remember, these things take years and decades to get developed. So, we go through 15 years in average to go from exploration to actually building a mine, of which 80% of that time is spent on exploration. And so the remaining is the engineering and the process of building the mine itself and then getting into production. And the permits and all those things, while things can change, you still have to find the discovery itself. You still got to get access to capital to finance the actual discovery. So to go back to your question, I think that exploration maybe will come back in terms of the majors spending more money, substantial more money. But I think that's more in the back end of this trend. I think first we're probably going to see if share prices start to rise of the miners again in a substantial way, immediately creates the currency aspect. That's their currency. It's not dollars, it's not gold necessarily. It's their share price. Share prices rise, they dilute the shares to purchase other assets and create other opportunities to expand their business. And I don't think we've seen this yet. That we started to see some fits and starts of the acquisition period. But I think there's a lot more to go there. And we're probably going to see one of the largest M&A cycles in history because of the suppression of exploration and also the supply in general. So the difficulty of finding metals is a real problem, and near term in the next, call it 5 to 10 years. And as we see all these spending and, for manufacturing and also, it's going to become more and more obvious that the mining industry needs to be critical aspect of the economy again. Just as a reminder, back in the 60s or so, mining spending used to be close to 20 or over 20% of GDP, and today is actually 0.3%. So, I think that I can see this. Some people say, well, this has been just a function of technology, right? We're seeing, the need for less folks working at those mines. We're seeing less, potentially less capex relative to the productivity, which is not true. But for some, if you go back to 3 decades, sure, we've seen some improvements in that front of productivity. But the real problem is that the U.S. economy and other developed economies have become largely dependent on ore imports, and that's going to have to change. As we see the changes of tariffs and all these protectionism policies across the globe at an increase, particularly with Trump, I would be shocked if they won't see, we're going to be drilling and producing oil, but we're not going to be producing metals. I mean, that doesn't make any sense. And so I would think that those policies will also flow into the mining industry in a large way. And that's going to be part of the opportunity as well.
Yeah, I've seen on Bloomberg, mention of small caps really having a time to shine now as we move forward, as well as that reminder that, Trump put together a critical metals list. Is it possible that there could be an easier path to permitting? We know he's going to drill oil and gas, but once again, people forget that he was very pro critical metals, and that larger macro, tell me if I'm wrong, that's not changing. I mean, they may not invest quite as much into like offshore wind farms, maybe, but those have already been baked in. A lot of that spending's already done. Am I correct in that assumption? Or
yeah, no, I think there's, the only thing I would add to this is that this has been actually very bipartisan as well. I mean, if you think about it, we've been in the Biden administration, and the DoD, Department of Defense, has been also granting, capital to the development of critical metal projects. This is now within the Biden administration. What do you think we're going to see coming out of the Trump administration, which is even more, bullish in that front? And so I would think that we're probably going to see double, triple amounts of what we've seen so far. And the amount of capital that's been granted so far is actually quite small relative to the size of the industry, quite small to the size of our needs of those metals. And so I think that securing that today is absolutely critical. And given the fact that some of those things take so long to be developed, regardless of approving everything as of today, we still need the time to build those things. And we also need materials to build that, the mining infrastructure too. So I think that we're likely to see partnerships with countries that we have not seen major partnerships for a long time. And I would be shocked if South America is not a big part of that change in terms of geopolitical agreements and all sorts of things that may occur. That's what makes me so excited. I feel like there's 2 big trends right in front of us that a lot of people are dismissing. One of them is the metals and mining industry itself that I've talked about extensively. And the second one is emerging markets. And it's not China. I'm not talking about China itself. I'm talking about very focused on, especially Latin America. To me, is at least where I can probably have better expertise. And I'm not an expert of anything, but certainly I was born in Brazil, and so I guess I have an advantage over a few people that don't understand the cultural aspect of that area of that region of the world, but also how unexplored geologically those areas have been. And we're seeing a real move in terms of politics in South America that I don't think is going to be reversing anytime soon. A lot of people concerned about Lula and others, but pay attention to what's happening with the trend here. After Trump came in, we did see Bolsonaro gain momentum and then became the president. and then lost its presidency, and maybe it will come back with Trump coming back. Then we saw Milei coming into Argentina, huge political shift in that aspect. And now we're seeing some other emerging politicians that are very much either pro-business or more conservative, of which is polarizing the region in a very significant way that we haven't seen in many decades. Majority of the politicians in South America are left or center left. And now we're seeing the other side of this in a big way. And I think that that's going to be translating into more capital into that region, not less. And so I'm very bullish in South America overall. And lastly, I think that there's going to be changes in terms of the refining infrastructure, of which China has basically dominated their market in a big way. The development of refining infrastructure in the US and other North American places, and especially North America, will be critical here. And that doesn't come, without materials either. So that's going to be a big change here in terms of the metals and mining industry overall. Will probably benefit tremendously from those changes as well. I mean, China is cornering the metals and mining industry in a big way from the refining capacity standpoint. And I think that that's going to become a part of the Trump administration focus as well.
It was really cool to see, like when you're talking about South America, and I'll just mention Argentina, just because you have that, it's on the border of Chile and Argentina, but that Filo BHP deal. And then, of course, Rio Tinto coming in for Arcadium Lithium. I mean, those are major deals that seem to really highlight when Argentina just said, knock, knock, we're open for business. We're pro mining. Let's go. And that was a big immediate reflection of Rio shifting and going into lithium, which is interesting. That's a whole other conversation. But that kind of highlights what you're saying, is that there's an under a movement and an acknowledgement of the critical metals. That's also not going away with any distraction of Bitcoin and this and that and whatever else.
Well, for some people, it's not a distraction. It's a way of making money. For me, is not I wouldn't call it a distraction, but I would certainly call noise relative to what I'm focused on, which is to really try to express his view that is bullish in metals and mining the best way as I can, as a fund, as even personal investments and client investments. I think there's a lot to be done here. Majority of politicians can't even put 2 to 3 sentences together about mining, and this is important. That not only reflects the opportunity, but also the issues we have, and the potential changes we may see, not only from new entrepreneurs that will be entering the space, but people that understand the risk reward. A lot of people, I guess, go after investors that take a stance on a certain company, a certain project, and those don't pan out. That's just part of the game, guys. It's the same thing as the venture capital industry did with the technology space back in the 90s, back and even now, in terms of betting on a bunch of different things and seeing which one will pan out. And that's just normal capital allocation. And so I think there's a lot of overthinking even within the industry of pointing fingers at each other rather than reuniting and trying to change the space and attract capital in a big way. And look, the metals and mining industry. Oops, 1 second. My computer just closed up. 1 second.
No problem.
There we go. I think there's a little bit of a laziness of as well of the metals and mining industry, given the fact that we naturally see these cycles come and go. And that forces those companies to not go through their own revolution of changes and improvements that we tend to see in other industries, because the commodity space will come and then will go, and then that's just part of the game. The ups and downs, the long-term ups and downs are it's a very cyclical part of the economy, and once it gets going, it could take 10, 5, 15 years. And then when it starts moving the other way, it can take as well, 10, 15 years. We've been in a very depressed market, particularly for the junior markets or junior segment of the industry for some time now, for over 15 years. Hence, look at the TSX Venture as a great way to look at it. That technically has been forming as well, an inverse head and shoulders. For those that are technically savvy would know what I'm talking about. And no, things at some point they reach a bottom, and I think we're approaching that here in this industry. And look, I can't help. I mean, I think it's difficult to see gold prices lower 10 years from now. And so if I'm of that view, you can extrapolate that opinion in many ways. I've never seen gold prices enter a bull market, a secular bull market that doesn't drive other metals, especially copper, especially silver, especially lithium. Should say not lithium, zinc, cobalt, lithium as well. Lithium is just the flavor, was the flavor of the day not too long ago, and everybody hates it now, but we'll come back to. And the nuclear industry and even agricultural commodities tend to perform well during a gold cycle. So when you are of that view and you understand that the underlying metal price will be, should be, or could be, is likely to be higher, then you can also extrapolate where do we have this legacy industry of mining, seeing potentially a secular movement of underlying metal prices. What does that mean about especially the expansion of multiples? And that's going to be the big change of the pricing of those projects, is when you start seeing the multiples going from price to NAV of 0 point something to actually over 1, over 2, maybe even over 3 times. Boy, that's when you see the big changes of revaluation of these companies. Don't even bother looking at technology. What is technology trading over NAV? It's crazy. So, or over sales, or
Yes.
over earnings. Those are all multiples that we could see potentially. If we see half of that in the mining industry, we could be in a very different place 10 years from now.
Let me kind of sum up and get your thoughts on this. I saw an article, a report from Goldman Sachs saying they expected the U.S. overall equity markets to be just running like 3%. They're not expecting the world. Now, right now, that's certainly not the case. It's driving forward. But within that macro, because you've mentioned before how small the mining sector is, you could have a pullback in tech because it's, one would argue, very, very well valued or overvalued, depending how you consider it. You could have the mining sector, which is critical. It's needed. It could have a 200, 300% overall sector increase, and it still wouldn't really affect the overall stock market as a whole, the Dow Jones and the Nasdaq. In competition-wise, the sliver is still small. It needs to grow substantially if it was to affect that overall return.
Yeah, my partner Kevin put out a great research regarding the behavior, counter cyclicality of the mining industry relative to the overall market during prior eras, which I think it's helpful. Although all those eras are very different to now, people get really hung up on 2008 and other periods, and even they forget even about 2000, of which the mining industry actually did well while the market was falling. And that is just unheard of today, right? In terms of a view. And I think I don't think this needs to happen, but I'm very open-minded to that happening, actually. And that is usually the case because gold, not always, that there's also this view that the dollar always rallies on when equity markets go up. When equity markets go down. So that's your safe haven trade. Not always. Look at the 70s. What happened with the DXY index during the 70s? It declined throughout the whole decade. What happened in the early 2000s all the way to the late 2000s? Despite the tech bust, the DXY declined. This environment that we're seeing today of the dollar rising with equity markets falling, in other words, acting as a safe haven, is a new thing. Historically, that wasn't the case. And so I am very open-minded to those types of analysis because, this is the same thing that happened to the 60-40 portfolio. 60-40 portfolio, everybody that missed the change in correlation was because you're focusing in the last 10 years. Why are we making the same mistake again now? And so to me, you got to be open-minded here. And I think that the concern over the mining industry over a recession or something along those lines is, to me, is overstating the problem here, of which, in my view, we're much closer to a bottom than a peak for metals and mining industry, especially the junior space has been suffering from almost no liquidity whatsoever. And there was a great interview one time with Senzel, who passed away over a year ago now. One of the smartest investors I've seen. He wasn't a market timer in terms of a short-term market timer. He wasn't the investor of the day of today, right? He wasn't a guy who was always chasing the new technology. He was a guy who was chasing legacy industries, big secular trends. He would miss 2, 3 years, 4 years of a move, but he would then be compensated by establishing himself into a new industry at the early stages. While everybody called him being early, being wrong, he was actually getting ready to become, one of the best investors that I've seen in my career. And why do I talk about him so much is because one time he said this phrase where, great money is made where there's lack of liquidity, lack of capital interest, and not the other way around. And put that, really think about that. I mean, where are parts of the market today that are lacking capital, that are lacking interest, that could potentially change quite drastically if the narrative shifts, which could happen very quickly. Emerging markets, if something comes to my mind, and the metals and mining industry is second to my heart in terms of views. And I think those things are highly possible. This is why I'm so focused in those two markets.
It's interesting because people will often make the analogy that like the junior mining is kind of comparable to, say, a biotech or pharma kind of play where there's a ton of R&D to get a pipeline going and only some work. Now, people seem to be okay with like hundreds of billions flowing into that pipeline with only limited success, really. But people get very upset with a pipeline, say, in junior mining. And it's strange because that is just narrative. I mean, they're both R&D. They're both exploring, testing. They're working a thesis to see if it works at each stage. So, what do you think? Do you think that that's a fair analogy, or do you think that that's being a little bit too basic?
Well, I'm very much aware. It shocks me when people talk about exploration businesses and are also surprised with dilution and so forth. And we've done extensive analysis on dilution of companies, especially successful companies, and how much capital goes into finding a discovery and all these things, because that's right at where the core of where we invest. And it's, even when you think about the dilution that we have, and we tend to see during these companies to go from a project becoming a successful discovery, which is your analogy with the drug space, is, in my view, it's, we're never seeing this industry being so undervalued as we're seeing right now. And those are the times, this industry is not going away. We still need metals. I mean, it's just not a new technology or a new thing that is going to be shifting away from this industry. Matter of fact, I think it's the other way around. I can come up with 50 arguments of why we're actually going to go back to this industry in a large way. And no, I'm not saying this is going to be a sexy industry in terms of technologies. It may be, it could be, but it's not really the play here. Is the fact that we, if fundamentally these companies are seeing improvements and nobody's paying attention to it, maybe one should. And it, it's very difficult. I mean, I think it's in some of the folks' genes when it comes to value investing and being able to take a contrarian view while everybody else is focused on something else. And it's, to me, this is actually fairly easy. If I see enough arguments to take a contrarian view, I will. And I am not scared of being unpopular. And to me, actually, the best ideas I've had in my career are the most unpopular ones. And they're so unpopular that I didn't even put enough attention to it because I thought it was too far fetched. I was very early looking at the supply issues coming out of the pandemic. I even did a research myself, very, very early, and nobody was talking about. I can tell you this because no one was talking about it. Even if you go back to my tweets back in the late 2020, and you will see it. And it was, I wish I would have put more emphasis on that analysis myself, and of how things were going to not only create inflation from the fiscal side or the money supply side, but really because of the actual issues with supply itself, which a lot of people dismissed until later on became very obvious. So, what is that thing today that everybody is not seeing that can become very obvious? And there's so many things in my view. And I think the industry of mining becoming critical again, to me, can be something that is, what if large institutions are all forced to kind of, through their mandates, become, more focused in that segment of the market that has just not seen enough capital in many ways. What does that do to those that have dedicated their life to become experts of that industry? So I'm bullish in this space because I think I don't see a way around it personally. I believe in AI. I think AI will create a lot of productivity, but in the back of that, we really need to build up infrastructure to see the rips of that technology, and we will see it, but it will probably take a lot of infrastructure development too, and also electricity demand, and so all sorts of things that ultimately drive metal prices, ultimately drive inflation, ultimately drive dilution of money, ultimately drive fiscal irresponsiveness. And all these things are very positive for the metals and mining industry. I don't know, how, it seems to be very stretched that one administration of will change all those big macro trends ahead of us, in my view.
No, and that's why I'm so grateful to have you on, because when you see like a hit in the sector, it takes wind out of people, and they think, oh, what's gone wrong, and I even have a tendency to you look at short term, and the brain is maybe because of social media is more geared to that way. But I want to ask you two things. They're kind of tied together, and I know we have to let you go fairly soon. What are some like very basic, broad tips and hints if someone says, well, you know what, I want to look at exploration companies and some of these juniors. What are some of the things they should focus on, look at if they want to go start getting interested? And once again, not giving away your model and not telling you to circumvent Crescat, but just something if they say, hey, where should I start? What should I be looking at if I'm looking at a couple juniors?
Well, I think that understanding what it takes to have a successful project, it's all sorts of things that a lot of people talk about, but a lot more than that. It's management, it's finding a company that has those, the foundation of capital well established with very, loyal shareholders that understand the vision, and a management that is incentivized and aligned to succeed, and I would say as well, a jurisdiction. Jurisdictions matter, but what matters the most is jurisdictions, not from a perceived risk standpoint, but really from, can we see a large mining operation in that place or nearby? Have we seen one? And those are important questions that I think a lot of people dismiss, and in places that are perceived as risky. And to me, that's the main focus as well. Outside of that, dilution is going to be part of the game. Understanding dilution will be part of the game, but how do you dilute yourself very strategically? Now, bringing partners into this, but also finding ways to not dilute yourself with capital that can be very disruptive later on to your stock. All those things are important, but when it comes to understanding the geologic upside and the geologic reasons to be invested in a stock, you really need technical expertise. There's no way around this. And, that's why I try to partner with the smartest, at least the smartest exploration geologists I know, which is Quinton Henney, a guy who understands risk and reward very well, better than most people in this industry, that don't often, go out there and say, this has the potential to be this, and this is how we're going to approach this and express this view, and how we're probably going to try to, persuade management to focus on what we think is relevant to create value, because we're aligned to the successful stories that we have, and so we definitely want that to come to fruition. So there's no easy way to answer your question outside of doing your homework, and also I think that the other thing that is very important is not chasing things that have already moved, is chasing the next one, is deploying capital into things that are as intrinsically important and relevant as that one that has already moved. And I think that also takes a contrarian, side of you to be able to take that approach, and it's not easy either. So those are some very quick thoughts on this, but and one last thing I would point out is when do you know when a company has reached its full value? It's usually, we've done a lot of research on this, but a good way to think about this is always about 20 in average, not in bullish periods. Bullish periods is a lot higher than that, but in average, to be conservative, about 20% of the value underground is going to be likely the market cap peak of a good exploration story. So, you got $10 billion worth of gold in the ground. $2 billion is going to be your market peak, just giving a kind of a sense of where to go. And, that's just a research based on, other peaks of other companies, and companies have been taken out at their peak and so forth. And you can kind of see that sort of trend throughout history. During bull markets, you may see 70% of that value. So imagine a company with $10 billion of gold could be worth $7 billion. But, I don't want to count on that. I mean, the one thing I learned in my, I guess, investing career is you want to find things that have alternatives to work for you. And, I don't want to, it doesn't require just solely that gold prices rise. It requires you to be successful on the drilling of that. If the price of the instrument itself is cheap enough that it's not reflecting the potential success, then that's already very relevant to me. And so then you have the macro trend that could work on the back of it all, and bringing capital into this industry again and seeing a whole wave of where all boats get lifted. That's a potential too. What if we see an M&A activity where it causes, speculation and all sorts of smaller names moving just because they're being speculated by the larger companies taking them out? That can be a big move as well. So all these things are important. Having alternatives and optionality to have something work is absolutely critical. And I think that we have that in this part of the industry in a big way.
And I'll wrap this up because we're called the market mindset. So I like to ask people too, and you've alluded to this a little bit, that those in this space, especially professionals, hedge fund managers like yourself, people that are in analyst roles, they would have a mindset or a type of personality, I would argue, because you're going to have to be pretty disciplined and be able to take a lot of pressure and build positions. Would you say that beyond the obvious, like data-driven, looking at over macro trends as well as technical trading of volume and charts and whatnot, would you say that part of the edge is that ability to not be pressured or moved by very short term, which seems like we're getting shorter and shorter timeframes of people's interest in trades? Would you say that that's part of what attracted you and what makes you good at it, and why you are a good fit compared to someone who may find this a very difficult sector to be in?
The only way to avoid short-termism in markets is to have long-term conviction. And that conviction won't come from listening to a smart guy that you like. So all the people, listening to this and thinking I'm going to invest in this and that. If you haven't done your homework, you're going to get shaken out immediately when there is a problem. And that's such an important thing. Being able to discern the long-term vision of an investment thesis, and being able to have those supporting points yourself to rely on at difficult times, because difficult times, if the thesis is right, difficult times will be proven to be incredible periods for you to be adding to your position, to be deploying capital, new deployment of capital, and surviving and also leveraging up your returns at times, and that you should be. And the only way to do that is with conviction. And, that, again, you can do all the work you want in terms of listening to people. But if you have not done that yourself, it's going to be very difficult. This is why that matters so much. doing your homework is it is probably the most cliche thing, but also the most important thing an investor should do. And as a fund, to me at least, what I try to do is identify big macro trends. That's number one, and that's supported by data that I put together, that I work on. And once I feel comfortable with that, and I know my thesis in and out, I know the other side of the thesis very well, and all sorts of things. That doesn't mean I'm going to be right. That just means I have conviction in my thesis. Then I can now deploy capital, which more, much more calmness. Like for me, when gold prices fall, it's like a win-win scenario. If they go up, I'm happy because I have investments in it that will benefit from it, intrinsically speaking, and also from a share prices speaking. Now, on the other side of it, if gold prices go lower, I'm also happy because I can probably deploy capital here in a very smart way and be adding and leveraging up to my position even more. So but the only way I can do that is by having conviction. There's no way around this. And so you can steal somebody else's conviction or thesis, but you can't steal their conviction and their loyalty to that idea in a big way. And that's what's going to make the big difference between making big money and making some money.
And one of the ways that you can strengthen that conviction and help is that you guys have every Friday, you go live as well, and you talk about the companies, and you get to refer. You'll get to kind of, I think if you consistently show up for something and listen, that helps as well. And you guys do an excellent job of being activists, of letting people know how you work, what you're looking at. Because once again, especially someone who's new, they might look at a result for someone and go, well, is that good? You guys walk them through that. You like to kind of, share with people as much, I call it free education, as possible. And that makes a massive difference because it's not an easy place to jump in. And we all need to do our best to help welcome and invite more people in. And certainly Crescat does an outstanding job at not only you with gathering such a great following over the last years, but Crescat as a whole of messaging and putting it out there and saying, hey, take a look. This is what we look at. This is what we're doing. Here's our macro. Here's what we're doing. That goes a long way. And I think it goes a long way with people out of respect for you, not just, hey, buy our fund, but sharing that to educate, to open people into it. And you're getting a lot of congratulations and a lot of respect for that. And we appreciate that. You guys are doing a lot of the heavy lifting for us. Yeah,
look, and the point of that, yes, of course, marketing is a big aspect of that segment that we do on YouTube. However, I would say if you have a thesis, educating investors as much as you can and providing quality data to back up your views so they can do their own homework is absolutely critical. A lot of people have done this in the technology space. They have done that on the banking industry. They have done that in the housing market industry, in different parts of the cycle, in the crypto space. And they all have their own relevance. And what we're trying to accomplish with those videos is all that as well. Is just trying to create sort of a process of investing that we have and sort of share that idea of how we view things. So for those that have similar views, can either invest or just consider those ideas to their own portfolios. And so that's just a way for us to share more about, how do we view the world and how do we view expressing a macro opinion into markets now. And there's going to be all sorts of opportunities. Lots of people are going to skin the cat in different ways. Some people like to buy things after they've put out results, positive results. Some others like to get into earlier. Some others like the development curve. Others like the producing curve. I'm not saying there's ways to do this differently, but that's just one way. And I actually would love that other people would do that more often in the industry. If you think that producing is a better part of the industry, do that. Do your case every on a weekly or bi-weekly basis, so more people can see that. And I think that the industry would benefit tremendously from this.
Well, thank you for all that work and also highlighting those necessary skills, not only the analytical skills, the curiosity and the critical thinking, but that that dedication to finding a thesis and chasing after it, and not being timid. We really appreciate your time, Tavi. Lots of people joined in here. Check out Crescat Capital, member and macro strategist over at Crescat Capital. Most of you know who Tavi Costa is, but it was a real pleasure talking to you, and enjoy the rest of the day, Tavi. We'll talk to you again real soon.
Thanks for having me, Andrew.
Cheers. Bye-bye.